Hi, thanks for joining me and welcome to today's video. Today we're going to be talking about the 9 investment mistakes. You're likely making one of them. And these are sort of the most common mistakes. They're not the largest mistakes, but they are the most common that I see when I'm talking to you. So whether you are working with an advisor or you're doing it yourself, I see these all the time and they're easy things to fix. And I'm going to lead you through them as quickly as we can go through them. And remember, put your comments below. I love your questions. I love reading your comments. And remember to hit that bell so you're notified of when I'm loading new videos. Okay, without further ado, let's get into why you're here today. The first, and by the way, these aren't the most common mistakes in order. They're just 9 mistakes. Okay, first one is overweight company stock. For those of you who are paid, part of your compensation is getting company stock. Be aware that as you go through life, it's probably the single biggest accumulation part of your retirement assets. So you might have an RSP with your company and then they do matching, and then they also paying you as part of the compensation company stock, so you get options in purchasing company stock. And over the years you're going to find that you're pretty heavily weighted in your company stock. Is that a bad thing? Not bad if you're working for a good company, but is it a bad thing to be invested in one thing? Forget about, push the company stock argument aside and just say, if you were to take all of your money and invest in one stock, doesn't matter what stock, I mean it does matter, but if let's choose Microsoft as a good example. Big company, lots of money, everybody's using their technology. But if all of your retirement assets were in one company, would that be a safe thing to do? Probably not. So think of it the same way. You're investing your money, you're getting money from your company, and you keep acquiring more and more of that, and it becomes overweight in terms of your overall retirement. So you need to divest yourself of that company stock. So you need to start selling some of that stock and turning it into, not turning it into something else, but basically turning it into your portfolio that you have, your personal portfolio, and invest in something else. So you are going to never have to be in a position where that company stock is that big elephant in the room and you're in trouble if that company goes south. Okay, so pretty common thing that I see. Okay, the next one, number 2, is investing too conservatively. I see this very often, and it's not that you're that fearful of the market, it's just you're just not sure what to invest in, so that you do it yourself, or you're trying to figure out what you could put your money in. You see this volatility, so I just go conservative, and you're investing like an 85-year-old. So you have to be aware of this. This chart is really good. It looks really busy, but I'll just give you some very easy ways to look at this. This is the probability of you running out of money throughout your lifetime with your investments based off of a certain withdrawal rate. If you look down the left-hand column on the very far left, that's the withdrawal percent. And then at the top, you see these cash position, and then it goes from 20-80, and then it reverses all the way to the other end, 80-20. So what this is really saying is we're going from a cash position, meaning it's the lowest risk portfolio you can have. There's very little volatility there other than currency risk. And as you start to go left to right, it's fixed income, a little bit of equity, and then that fixed income as we go along becomes less and less, and equity becomes more and more. So what this is really trying to tell you is that if you are doing a withdrawal, and let's choose 5%. I'm not going to do 4%. Everybody, you've seen the videos on 4%. I'm going to do 5% because this is kind of where you are when you're 65 to 70. Your RIF, if you look at how much money, you can Google that and say, what is the RIF minimum withdrawal rate? You'll see that it's about 5%, and it goes up from there. So it's a good place to start. If you had all your money in cash, the probability of you running out of money is pretty high. That money would last between no longer than 5 years on that 5% withdrawal rate. If you have a little bit of fixed income, well, actually a lot of fixed income in this case, then there's a probability that you'll run out of money with, there's a 45 to 50% if all you are in mostly is a fixed income portfolio. So think about that. Fixed income portfolio, let's say you're getting 4 or 5% return, and your withdrawal rate is 5%, so you're really not making any money here. You're kind of, as your withdrawal rate increases because your RIF each year, you are starting to really dig into your own capital in a very, very advanced way as you get older, and there's a probability of running out of money. So you go across, you can see as you introduce equities into your portfolio, the probability of you running out of money becomes less likely that you're going to run out of money. So this is very important for you to understand that some of your money in your portfolio, you have to have some weighting of equities in your portfolio. So work with your advisors to what kind of equities would be not so risky, but sort of middle of the road equities that you could feel comfortable having in your portfolio and not feeling too worried about volatility while you're owning them. Okay, so that's this, just trying to tell you, got to have some equities in your portfolio. Okay, not knowing what you're paying for. This one, there's no slide. This is just me and you talking about this, and so you can understand what I mean by not knowing what you're paying for. If you are working with an advisor and there's a fee, it's either in the funds that you're working with or the advisor is charging you a fee, then you have to ask yourself, well, what am I getting for that fee? So many people have a fee that is to manage the money. So this is the assets under management. So they'll charge you 1%. And many of you are going, yeah, I understand that. I get 1%. So what does your advisor do for that 1%? Are they just managing your portfolio? Hopefully they're also talking to you, calling you and emailing you and talking about your portfolio and doing reviews with you. Are you getting any retirement planning? Is that included? Is there any estate planning included in that? So understand what you're paying for. So when you look at your portfolio and you look at the costs and the fees of your portfolio, and by the way, I'm not talking here about fees are a bad thing. I really believe, and so do you, by the way, you don't mind paying for something, even if it's a little bit more money, if you're getting value, right? How many of you go and buy not the cheapest thing on the street, right? You go after something that is good quality and adds value in your life. You don't mind paying a little extra for that. So you have to ask yourself, what am I getting for the fee that my advisor is charging? So if you are looking at that, just pay attention to what kind of services that they provide. So many of you are paying a fee to your advisor and didn't know that you could actually get planning. They just never bothered to offer it to you for some reason. So ask your advisor, hey, by the way, does that fee cover planning? Can I get a retirement plan done? If not, then you need to start thinking about where you can get a plan. Obviously, people come to us and need plans done, but just understand, ask those questions of your advisor. What am I getting for the fee? I just want to be clear about what you do for that. Not complaining, but just want to know what that is. So you really would like to see, if you are working with a broker, for instance, they probably aren't doing planning, and their job is to just multiply the money that you give them. And so, well, how much is that their service and their expertise worth? What should they be charging? That's how you value that. And of course, are they making you money is an important thing. And then if they're doing planning, you say, okay, well, I'm paying this fee, let's get a plan done and start to dig into that. So always look at what is the fee that you're being charged and what are you getting for that, okay? The impact of inflation. Many of you, when I'm doing a plan, want to know what the inflation rate is that we're putting in the plan. And by the way, it's usually 2.5% to as high as 3%. And what the impact of inflation is. And so this is really important. You must know that the most recent, let's say 5 years, going back to COVID, when things got really expensive because of all the disruption in being able to get things that we needed, costs went up. Costs for food are up, that kind of thing, fuel, all these things have gone up. What's the impact of that? Seniors having to figure out how can we, continue to buy what we're buying, groceries and so on, with the cost of everything going up. So here is a great slide, 2 slides here for you, to just show you the impact of $500,000 invested getting 7% rate of return and looking at different inflation rates. So the green line shows if you had a 2% inflation rate, again, here's the caveat, $500,000 at 7% rate of return. You can see that's going to grow to $1.3 million. At 3%, you're losing about $200,000. And then at 5% inflation, that is really punishing. And we've seen that inflation in this last 5 years where we're as high as 8%. So inflation is a really important part of your planning to understand how it steals your purchasing power. So let's go into purchasing power. When I'm doing a plan, this is just a sliver of the plan, just to focus your attention in on the expenses and not all the retirement assets. Here we're looking at Bill and Mary, and you can see they're 70 years of age, and that's why I was talking about sort of like seniors, to see because you're on fixed income mostly, right? You are drawing down your assets, CPP, old age security, your RSPs, your liras, your LIFs, all these things. And that's all the money you've got coming in, unless you have some rental income coming in. And you have to be very aware of what is inflation doing to your purchasing power. So in your plan, you see this column that says base, and you two columns, real and nominal. So real is Bill and Mary's intention to spend about $71,000 a year of after-tax dollars. But as they get older and as time goes on, inflation is really pulling at that, right? It's degrading your ability to be able to afford things because things are going up. So you see this nominal column, that is the effect of inflation. So if you look at age 74 or year 2030, you can see that $71,000 is now actually $81,000 adjusted for inflation. So that is what you actually need to keep that $71,000 of purchasing power. You actually need $81,000. It's $10,000 difference, and not that many years going by. So that's the impact. This is a 2.5%, by the way, inflation rate. And so you have expenses like travel, and maybe you want to give money to your kids, and replacing car leases. All of those expenses are going to cost you more as you go through life. So it's important for you to see that in your plan, inflation is a very important aspect to consider. Okay, trying to time the market. Well, this is really hard to do, right? Because the markets have been all over the place, and when you have an extremely volatile market, you're trying to pick your moments and try to get in and out. I don't really advocate that you try to do that, but let's just look at what happens if you get it wrong. So if you were to take fully invested and never touch your money, just leave it in and let it go down when it, I'm not advocating that you just watch things go down, but you see when you're fully invested over time, if you've got a lot of time in front of you, you would have had from January 3rd, 2005 to December 31st, 2024, $10,000. That's what the growth rate would have been. You would have had a 10.4%. Now, if you had been trying to time the market and you missed the best 10 days during that period of time, it go from 10.4 down to 6.1, and it just gets worse and worse. You can see that box in the middle of the screen. 7 of the 10 best days occurred within 2 weeks of the 10 worst days. So what does that mean? When you look at the markets and how volatile they are, and we get these sudden drops, and then we call it oversold. The market is panicked too much and people have sold and got out of the way. And then the market reverses very quickly and the market goes up before you get back in. And so you lose twice in that environment, right? So because the thing that you wanted to buy back into is now costing you more than when you got out of it. So it's really important to work with your advisor to develop a portfolio where you feel that you're not taking on too much risk and stay invested, and to not worry about the markets as much. Go to this video up here about the 3-bucket strategy where I talk about how to use your money, invest in a certain way so that you don't have to worry about these bad days too much, okay? Not having a withdrawal strategy is the next one. Well, that's why you contact me mostly, right? You have a tax problem and you need to have a withdrawal strategy. You recognize that you've got a lot of money in your RSPs or your LIFs. You may have a pension plan, some income coming in from real estate, and you're trying to integrate all these things of when to take CPP and old age security, and you don't really have a really great withdrawal strategy. You just say, okay, I'll take some money out of my RSP. And that's not the best way to go about doing that. So when you look at a plan, as you see here, you can see on the right hand side these yellow columns. That's just highlighting a withdrawal strategy. You can see the person's 72 years of age, and we're drawing down about close to $800,000. We're drawing down each year to try to get this person out of their RIF by around 85, 86 years of age. That's the average mortality of people in Canada. Men and women are differently, but I try to get most of my clients out by around that time, 85, 86. Now, what does that mean, out of your RIF? It's not that you're spending you could be spending your money, but it's not that you're spending it. When you do the withdrawal, you're voluntarily paying the tax, and whatever you're not spending goes into your TFSA and then into your non-registered account. So it's not disappearing. And what we're trying to do in this withdrawal strategy is we're trying to keep a fairly level tax rate. And you can see the effective tax rate here in the middle, where we're around 18, 19%. And so this person has a tax rate like that all the way through while they're doing a withdrawal. And we're integrating CPP and old age security and other income sources they have. What you don't want to see is you don't want to see your tax rate spiking like this, because that's costing you more money in taxes. So you want to have a withdrawal rate that gets you out of your RIF by a certain age. Whatever you're not spending goes into your TFSA and then goes into your non-registered account, and you keep that effective tax rate as level as you possibly can. That is a tax-efficient withdrawal strategy. How are we doing, by the way? Any comments? Remember to hit that like button, share this video with anybody that you need to see it, and remember also hit that bell. The algorithm has changed. You actually have to search for the videos now instead of it just being right in front of you. Global versus international equity. This by far is one of the biggest things I see in your portfolios is this confusion about thinking that you're invested globally, and so you're across the board and you've got lots of money being spread wide around the world, and that isn't really the case. A global versus international. Let's look at these two charts. On the left hand side is a global equity fund, and on the right hand side is an international equity fund. The global equity fund, look at the top position, 62%. Check out any global, first of all, go to your own portfolio, look at your global fund. Is that what you intended? Did you mean to have 60% of your money in US? Because it's likely that you have other funds that also have US composition in it. And so now you're really loaded up on US. On the international side, it's not even in. US isn't even in that. So what is the difference between a global and an international fund? An international fund is everywhere else around the world except for the United States. So if you want to break up your portfolio so that you are being intentional about where you want to invest, remember, if you want to just have a focus in one fund or some positions that are international, choose an international fund, go into the fund, look at the composition to make sure the weighting from a geography is that it's all over the world except for the United States, and then pick a US equity fund, not a global fund, a US equity fund, and it'll be like 98% US equity. That's how you can tell the difference about how you're invested. And so many of you are overweight US equity because you have US equity fund, you have a global equity fund. Now you're really having the US. So pay attention to this. I see this all the time. What you think is global and you're all over the world, you're not. Highly correlated portfolio. Well, why I'm following up with that is because what I just talked about, being in a US equity fund and then a global fund, and you think you're more all over the world, actually you're highly correlated. So that fund, that global fund, has US weighting in it, and then your US equity, they're invested in the same thing basically. So look at this here. This is something that I do with people when they ask me to do a portfolio review. You send me your statements. It's free. There's no cost doing this. There's no hidden agendas. I just simply do a review and send you back the information. If you want to have a Zoom call and talk about it, I can. But essentially, this is, I think, one of the most important pieces of the portfolio review is the correlation matrix, we call this. Easy to understand, super easy to understand. Look at the far right hand side. This is the legend of a person's position. So you send me your statements. I take all your investments, we load it into software, and here's your funds that you're invested in. So in this case, there are 13 funds. Have an issue with that right away? Probably too many funds. I'm not even going to say probably. Too many funds right away. So the one problem with this portfolio is way over diversified. That's too many funds. And then the second thing we look at is on the left hand side is this diagram that you see here. So all the numbers that you see in that investment key on the right hand side, 1 through 13, are in this on the left hand side. Those are the funds as well. And so what we're looking for here is what is the relationship of number one, let's say BMO Concentrated Global Balance Fund, to the number two fund, which is the CI Diversified Yield. So we can look at it. We go down the left hand side, we go column number 1, fund number 2, there's a 74% correlation. What does that mean? Is that the underlying securities of the fund that is in the BMO Concentrated Global Balanced Fund, 74% of those stocks are in the same fund as the CI Diversified Yield Fund. It's pretty easy. So what you want is the light. Look at this on the bottom degree of correlation. You want to try to avoid the dark blue and the light blue. You want the grays and the colors as much as possible in your portfolio. And in this case, nearly everything that they have is highly correlated. So not only are they invested in way too many funds, but the funds that they've chosen are kind of duplicating each other. So all the fees you're paying, when one fund goes down, all the other funds go down with it because they're holding pretty much the same information. Look at the correlation. If you go 7 across to 4, 96%. 7 across to 3, 96%. Go on and on and on. This is a huge eye-opener. When I deliver this information to somebody, they just go, what is going on? Why is my advisor choosing funds that are so highly correlated? Because they're likely stock or fund picking. They're likely looking at what is the portfolio returns over the last year. They'll just go 1 year return, click a button, and it sorts all the funds, and they can see funds in 1 year returns and 3 and 5 and everything else. And they're probably just saying, okay, what is the 1 year return? And stick that one in, stick that one in, stick that one in. And it's not really an efficient portfolio. In fact, you're not doing yourself any favors. You haven't lowered your risk at all. You just have a highly correlated fund. So hit me up on doing a portfolio review. I will do this for you free of charge, send it back to you, and answer any questions you have about your portfolio and how you should be invested. What do you think of that? It's a big eye-opener. I just love delivering this one. Not having a plan. I think we're done. Last slide. Not having a plan. Really, I walked you through this slide before and just showing you what it looks like when you have a tax-efficient withdrawal strategy. If you don't have this, you are either trying to figure it out on an Excel spreadsheet, you're going about your business every day, you're either working or you're traveling and enjoying your retirement and trying to do this at the same time, trying to worry about the stock market. What's your withdrawal strategy? Just have some professional give you a proper retirement plan so you can be rest assured what to do. Follow the withdrawal, what we're recommending you to do each year. Talk occasionally with that advisor and do follow-up meetings so that you can be still on track to make sure everything is working fine. But not having a plan means you're going to spend more money in taxes. You're likely going to leave money behind for CRA to tax your estate at your passing, which is another huge tax bill. And you have anxiety about worrying about, do we have enough money? Can I spend a little bit more this year? We want to do this bucket list trip. It's hard for you to figure that out. And so just get a plan done and you won't have these worries at all. Okay, well done. Thanks for joining me on this video. I have a question for you, as I always do at the end of the video. What mistakes have held you back from retiring on time? So when I say on time, meaning you thought you would retire in 2025 or 2026, and now you're pushing that off because some mistakes you made have caused you to actually delay your retirement. Put your comments below. So many people want to hear or read what other people are doing so that they can learn from your mistakes, right? Us growing is us making mistakes and then never repeating them again. Okay, thanks for tuning into this video, and I look forward to seeing you in the next video. Thanks, and be well. Take care.